Hello, folks. Welcome to State of the Market. This is David Russell, Global Head of Market Strategy at Trade Station. It's great to be with everyone. Today is Monday, June 23rd, 2025. Start with a few disclosures and some important information I'm going to include in the chat. I also want to remind folks that Trade Station is preparing to launch Titan X, the next generation of our trading platform. It isn't just a new model of our award-winning software, but a fresh trading paradigm that puts you in the cockpit like never before. Titan X will be available to customers as a beta soon. If you're new to TradeStation, you can join the waitlist at tradestation.com/TitanX or see the description in see the link in the description of this video. All right, let me show you the standardized returns to the ETFs we've been talking about. Now, remember, in this webinar, we basically do, we look at the indexes, we look at the sectors. We don't look so much at individual stocks, although some of them are kind of interesting. Now, also, a lot of the information that we have has been partially covered in a blog post we have today. So if you go to tradestation.com and you scroll down the page, you'll see a blog post here. Oil and war are not the only stories in the market. So it's kind of interesting here because last week was kind of interesting because we actually saw last week, major news with cryptocurrencies, but not so much cryptocurrencies as much as the technology of stable coins. So you can check this out. There's a lot been written about it, last week. But there was some interesting options activity that we covered here. But you might want to just check it out because it actually shows that there are other things happening in this market. And honestly, it's kind of consistent with more of a risk-on sort of market when you see IPOs going up 500% or more in the space of a few weeks. Things like that are a different kind of market. So as you look at the overall situation today, here's the S&P. Interesting sort of range that we talked about in place. And I think this tight range is really the key thing. And let's just talk about some of the things that are really happening. So today, essentially, we've been waiting for this, the American attack on Iran and now the Iranian response. So today we got about an hour and a half ago, an attack on our American air base in Qatar. And honestly, it's like could be viewed as a bullish thing. And I think the reason is that, first of all, it's far from the Straits of Hormuz if you look on the map. The other thing is it looks like the Iranians used missiles that were not terribly hard to shoot down. There even seems to have been sufficient warning given. So this says that this was a gesture. It was kind of choreographed. It wasn't intended to really cause a lot of damage or to escalate things. So that gives a sense that there is at least now the potential to view us in a situation where this geopolitical unrest could fade from here. And this could have been a point when it doesn't go much further. So it's interesting that we look at oil very quickly. We're using TradingView here, but look at oil getting hammered now. This is a buy the rumor. Here's the rumor, sell the news. So basically, by attacking Qatar and not shutting the Straits of Hormuz, that was the rumor, and they sold the news. And that's basically what we have now in oil. So this shows the worst case scenario not happening. And I think this is actually, probably the chart of the day. I hadn't even seen it, since this candle got so big. But it shows that, oil gapped up, and then it basically, got sold really hard. So I think it's kind of interesting because last week there was an article in Reuters that said that oil producers were selling forward production to hedge prices, locking in prices. So basically that was another case of people selling the news, so to speak, or at least selling into the strength. So I think there's something else happening here. In my view, there's kind of a new dynamic developing that could be actually quite bullish for stocks. Part of it is that today we had Michelle Bowman, a voting member of the Fed, talk about rate cuts in July. Last week we had Christopher Waller, another voting member, talking about rate cuts in July. So the Fed has kind of gotten more hawkish. Last week, their statement was a little bit more hawkish, but at the end of the day, it's pretty ambiguous. And they were also talking about not having a high degree of confidence in where they are, meaning that they can flip-flop. It doesn't mean a bad thing. It means that they could turn dovish. And now we're hearing those sounds. So I think it's important to realize that. So we are getting to the spot now where the Fed could be getting more dovish. And I think the other thing that's important to realize in all this is that we remain in a situation where the inflation data has not gone up. There could be some effect from tariffs, but the exact way it will play out, is unclear. And as I've said many times, there is this potential for housing to become deflationary. And that could actually have a huge impact because it's the biggest part. So we had this brief rise in energy prices, but they could come back down now. And then if we see housing continue its kind of falling, sort of pressure, those two things together are a substantial part of the price index, energy and shelter costs. So I think that's important to realize here. The next part of the big dynamic is that the AI CapEx cycle seems to really be in place. Not an important stock overall, but Jabal Circuit last week was a big gainer in the S&P because of AI. Advanced Micro Devices had an upgrade because of the potential for more AI. We've been talking about names like Amphenol, which is just, no one talks about this. So they make like Ethernet cables. They make all kinds of stuff for AI. They had this strong report back here. They've been running higher. This is the same sort of thing that we've been talking about. When you see the hardware names, when you see the companies that do the picks and shovels doing something in any industry, that's telling you that the end demand is there. And so I think that we've been talking about this structural strength in the data center hardware side for a while. Things like Micron, things like Seagate, they all point in the same sort of direction. Cisco Systems, the kind of, forgotten child. We did a trading view idea on that one not too long ago. And, this stock is, it peaked at $84 back in the year 2000, the beginning of this century. So it's kind of interesting that here's a name that has been kind of, that has that AI exposure. And here it is still below its all-time high. But again, this is kind of what we're seeing. And this is not consistent with the bear market. We are seeing strength in the sectors of technology, consumer discretionary, and we're seeing the safe havens, especially healthcare, but also even stuff like consumer staples. Healthcare remains weak. Consumer staples, not so, not very strong. So if you look at the internals that are kind of developing here to a certain extent in the market, we kind of see oil peaking, AI ramping, the Fed potentially wanting to turn dovish. And then we even have a little bit of M&A news today with the idea of Bank of America. Oh, no, I'm sorry, not Bank of America. Bank of New York Mellon targeting an alleged takeover interest in Northern Trust. Again, just when you see the M&A, that is not a bearish thing overall. You see an IPO, like we wrote about in this article, Circle having a big move out of the IPO. These are more consistent with a risk-on kind of market, that kind of activity. So we go over here at our article. I'm going to just blow up my chart. Hopefully you can see it well. To me, what's really interesting here is the Bollinger Bandwidth. This range is pretty actually abnormally tight. I'm not going to take the time to do it right now. Well, I can show you this very briefly. If you look at the size of these candles, these were the smallest candles, high to low, since somewhere back here, since this candle in early December. The week begun 9th of December. The last 2 weeks were the smallest ranges on the weekly bars from high to low. So these are very tight price action. Now, that was at the end of a relatively extended rally that had been going for months, if over pretty much a little more than a year. That's potentially kind of reversal fatigue. But this is something that's been going now for a month or two. When you really look at, if we have, this is a new real kind of bullish thrust, and we're holding very tight here on the weekly. So from my perspective, that tightness is an interesting thing. That we also see here, the tightness on the daily chart in our article is expressed by the Bollinger Bandwidth. Now, so to me, that's actually the key thing I want to point out here is that we're seeing this tightness, and it does suggest a lack of sellers. I'll also mention that on the daily chart, this is actually very similar to what we saw back here in late 23 when we started to rally. You can see these tight patterns here. In fact, I can't believe it, but I'm going to actually, I remember I used to talk about this pattern a lot, and it actually did kind of work. I'm going to actually move this pattern. I'm going to put one over here now, this kind of tight gray consolidation, because it does kind of actually show you what can, when you have this tightness like this, it can often resolve to the upside. It's very interesting here that the Bollinger Bandwidth back at this time in December, see the S&P's all-time high at that time was 4,800. So if you look back here in December of 23, the Bollinger Bandwidth also collapsed, and then it shot to new highs. It also collapsed here, went to new highs. So basically the Bollinger Bandwidth was compressing as the market came off the lows. Now we see our Bollinger Bandwidth kind of compressing as we push against these levels. So I think it's important to realize this was when we kind of had the, moment. This was when the market crumbled, then then Trump started getting aggressive with tariffs, and we really crumbled down. And this was kind of a resistance area. And so I think this is now an interesting area to see, this area, between kind of 59.65 and 6,000. This has been kind of this peak across here. And what's interesting is you can see we peaked at that level back in May. That was our high of May. And now look, we're trying to turn it into support. So, I mean, there's a lot of ways to draw this. And if I were to draw it anywhere, I would kind of look, it's essentially this line on this chart. Maybe it could be a little higher, but the key thing is you can see that this level was resistance. It was resistance, and now it's becoming support. So I think that we're basically seeing a tight range here, not very far from the highs, as the internals look not terrible. We've seen the advanced decline line improve. We've seen the companies above the 20-day moving average start rising again. We're seeing our sector mix be bullish with strength in the risk on sectors. So all those things right here could actually suggest that amid all the kind of frightening stuff happening geopolitically, we actually have within the market something that could be more constructive. It's also interesting to point out, and I think this actually builds to the overall argument, but it points out that one of the key things is that the economic data has kind of been weak. Retail sales were bad last week. Housing was bad last week. But at the same time, we see technology and industrials breaking out to new highs, as we've talked about, and we will talk about again. So XLI again. I mean, we noticed how that was the first sector to hit a new all-time high earlier this month, and the overall market was not. Then technology hit a new all-time high last week for the first time ever. And so technology and industrials are now the leaders in terms of where we are versus all-time highs. But those are risk-on cyclical areas. So we're seeing retail sales weak. We're seeing housing weak. We're seeing cyclical areas strong. What is that? It is data center construction. That's why we're seeing it in Jabal Circuit and companies like that. So again, this is just a sort of thing we're seeing now, which is in some ways could be a very a positive combination for sentiment. Consumer weak, which can keep the Fed more dovish, but enterprise and AI and tech strong, which can keep the NASDAQ, can kind of get something more positive toward the NASDAQ and toward tech stocks. So when you actually take a step back, we could be looking at an environment that actually could be philosophically or thematically actually quite positive, of a Fed that's getting more dovish, of a tech cycle that is strong and getting stronger. Don't forget earnings season in about a month and a half. Will people sell before earnings season, or will we run into earnings season as people look for more strength? So you have the Fed in there, you have the tech in there, and then you have the geopolitical / trade, tariff, whatever, Middle East, all that stuff. If it just kind of fades or doesn't get worse, well, those things come together with some really tight action on the S&P. So I think that's an important thing to realize. Also, I think it's important to realize here is that we could be seeing the end of the Sell America trade. The dollar index here has been holding. It's not to say maybe we have huge rally in it, but I think it's interesting that last week, Reuters also reported that they had a pretty significant outflow from global funds, funds investing in foreign stocks and things like that. And I think at the same time, if we're looking at NASDAQ, AI, everything like that, we could be setting up for a good old-fashioned mega cap growth, maybe not mega cap, maybe just broad U.S. tech growth sort of rally taking shape, with the potential to pull market to new highs. And I say that based on the evidence we're seeing, and also the fact that even with the Fed kind of gets dovish, the dollar has dropped. And in many ways, this weakness of the dollar has been a function of people selling U.S. assets. And if we get back into a tech rally, that is not necessarily going to be a negative for U.S. assets. It could be flipping the other way around. So I think that's kind of important to realize here. And it could also, even with the Fed potentially dovish, it could actually be something that is not terrific, potentially even for gold and stuff. Because again, those have been safe havens. If people want to come back to American assets, to the traditional kind of idea of U.S. stocks and risk on, it's not clear that gold will perform in that environment. So I want to just kind of mention that. All right, now we look at the S&P here. Going back here to the S&P on the weekly. Those are the main things I wanted to mention just to kind of get started. I thought it was very interesting to see those outflows from the global. Now, to me, the key thing remains this range, which we've talked about for several weeks now. There's a few places you can put these lines. You can also look back to Christmas week. it kind of starts there. The Friday after Christmas, I think it was the 27th. Basically, that close, was that week ended at kind of 59.70, and it's more or less, it was then the kind of the high as we broke down in early March, and it was kind of that high again in May where we stalled, and it's kind of turning into support here. So we're kind of just nudging our way back. We're back above 6,000 here. And I also note that since we've been so tight on the daily, we could be setting up for an outside day. We're not there yet, but we're about 6 points away from an outside day. So we had a low that did not hold, kind of a false breakdown. We tested the 21-day exponential moving average today for the first time since the end of April. That's actually kind of interesting to think about. Today's low was the lowest price since June 5th. Now, last week, we actually kind of looked at this potential low from June 2nd, the monthly low, and it has not even, it's consolidating above it. So from my view here, it's very interesting to see the old resistance at the May 19 high turning into new support. All right. Now, the Qs on the weekly. So remember, if you want to see some of this stuff, go to my article here on tradestation.com. And the oil and war are not the only stories in the market. And, I think AI and now this crypto stablecoin thing, this could actually be another potential story. You could see companies start talking about how they have exposure to stablecoins in various ways. Fiserv, FISV, actually tried to make an announcement like that today. Now, again, whenever you have a new boom, companies will try and jump in and kind of jump on the bandwagon. But this also could be something of a narrative we see kind of going forward. So now the Qs are in a very similar spot, kind of just consolidating in a range here. And, from my perspective here, we've now had, they had a chance to break down and they did not choose to do so. And I think that's kind of what's important here. If you look overall, look at the low. I mean, basically, this thing closed. I mean, the low was almost identical. You had a low at 25.73 and then 24.88. So you had lows like 50 cents apart from each other, not even. So that's like a minuscule amount. They closed at almost exactly the same spot. So this is tight price action. Now, it's also interesting to see that the previous week before that, we consolidated above even that level. I mean, normally when you get into a range like this, you get these lines that are so small that, it can kind of drive you crazy. But it's interesting to even see that high from the week at the end of May, basically that high of 26.48, we basically held. So again, I think here we're seeing, this tight little, resistance becomes support. And so this is also consistent with the kind of tightness that you'll see when there's not necessarily, potentially see when there's not a lot of selling pressure. So in the daily, there's really, I don't think much about the Qs that are really all that different than the S&P 500. Also, this test of that 21-day exponential is actually something that people could actually say, well, now we've done it. We needed to do it, and now it's been done. And that might actually give people a little bit more sense of continuation if we test it and hold. Now, the Dow is kind of in purgatory here. And, this is something that we've talked about. And, from my view, this is something where it's not necessarily, clearly, bearish, so to speak, at this moment. I mean, it shows that there is lagging in the Dow, lagging in the Russell that we're going to show. But I think overall, this is something here where it is kind of holding these levels here. And at a certain point in time, especially as we get toward bank earnings, people might look for some kind of, kind of breakout from here. But from my view here, this is now stuck in something of a range. And right now, the focus seems to be on the larger tech and the Qs. Now, the Russell also kind of just kind of stuck. Remember we mentioned last week how it's the only major index below its January high, where the old resistance becoming new support. This could just, I think in many ways, the Dow and the Russell here could just kind of turn into just drifting zombie land as people focus on the tech trade. Now, there is some potential that if the Fed gets dovish, that could turn into something bullish for the Russell, but it's not super clear how exactly that will happen. I will mention that Jerome Powell speaks in Congress tomorrow, so that has some kind of potential. I mean, at this point, from my perspective, you look at things on the chart, people would want to see kind of a breakout above this kind of reversal day, this reversal week here. And that is something that we haven't seen yet. And, I don't think we're talking about massive rate cuts or anything like that. So at this point in time, the Russell seems to be an area that continues to kind of struggle. And so I think people have realized that when it doesn't have the relative strength happening here, and it could, be something that simply sputters for a while. Now, the 10-year Treasury is quite interesting. If you really think about it, as inflation moderates, we get to a spot where people could actually argue that there is a value in treasuries, that they're too cheap versus inflation and stuff like that. So I think that there is getting to a point here where there's a supply coming from deficits and all that. But if we really do get to a spot when inflation comes down, and we get to a spot when the whole sell the dollar, America, sell America, and all that narrative fades, people could actually see there being a value in treasury, in the actual price of treasury bonds, which means yields could move lower. To me, the key thing is, and we've been pointing this level out for a long time, between 460 and 465, it has been resistance. And I think it's important to see we have a high back here in 23. We have a false breakout in April of 24 and January of 25. Then we basically made a lower high in May of 25. So from my view here, this is something where people might actually see some potential for this to just kind of remain stuck here around 4%, back down toward 4%. So this June 2008 level, I mean, I think it's important as a reference point, but I don't want to make too much of a to do about it. From my perspective here, the near-term levels were what matter, and you can kind of see this having space all the way down under 4% here. So from my view here, this is also kind of consistent with what would kind of be a positive thing for the market overall, and the sense for equities and for risk on, and some sense here that yields, at this point, don't have a whole lot of clear upside. Now, that was TNX. DXY, the dollar index. I want to just mention, look at the weekly chart here. I mean, it's not a bullish chart, but it is not breaking lower. And, it doesn't have to go back to 106 or something. It could simply kind of chop here, maybe go up to 101 or something. And in that process, that could be something of a rebound over a period of 1 to 2 months. And that could actually, take some of the energy away from things like global and gold, and bring some of the energy back to the large caps or something like that. So the point is that this here seems to be kind of pausing and stabilizing. And so I think at this point, this might be something that actually creates a little bit of a pendulum swinging the other way versus what we saw in the first half of this year. First half of this year was sell America, capital flight, blah, blah, blah. We talked about it at the time. It played out, but now that trend is showing signs of having kind of halted, and there's a potential for it to reverse. And we're seeing things, like I said, about the NASDAQ and the growth in the technology and the geopolitical risk potentially fading and potential earnings growth and all those things that could also complement here. So I think with the potential here, with the S&P not that far away from its all-time high, the NASDAQ not that far away from its all-time high, if we see a kind of run toward new highs, then this dollar, downside may pause. And I think that this is something just to kind of think about. This is something actually that could be a little more positive for the U.S. Markets overall. Now, materials, XLB, sector fund we look at. Now, these are all kind of like the small caps. They're just kind of stuck here. And so from my perspective, people can look at a range here between kind of 80, 89 and kind of 85. So I think we have to realize that this is a cyclical, kind of similar to the small caps. With the overall cyclical economy not amazingly great, this is not the sort of area where people might look for real strength. A lot of weird kind of companies in here. So from my view, this is something that might kind of sputter around. The lower weekly high on this is not a terrific sign. So people might actually view this as being something to more or less avoid on the long side. Now, the XLC communications are kind of different than that. Now, we've kind of talked about the big three. For us, the big three are XLK, XLC, and XLY. Those are essentially your large cap growth. So we're going to get the XLK, which is technically this is the XLC communications. It has Meta, it has Google or Alphabet, it has Netflix. Those are the big names. It also has lots of other smaller traditional media names. What's interesting about this is it also remains in this tight range here. Doesn't look that different than the Qs. See, it's holding this recent highs, basically held, probed above. So from my view here, this is something people might actually look now that we've held and consolidated for a few weeks. People might actually look for this to continue to new highs in XLC. This could turn into a tight kind of flag before continuation to the upside. Again, you might want to, I'm not going to get into it today, but remember, we showed you in the past how to mine the earnings calendar using TradeStation's award-winning platform. We'll be back in July, the weekend after the 4th of July week. I think it's July 10th. I actually should have looked at that. But the week after 4th of July, we'll be back and we'll show you how to start getting ready for earnings season at that time. That's XLC. XLE, all geopolitical here. And, now I think we just have to realize is that, this is a range. And, I think at this point, all of this stuff is kind of now gone. And now we're just back in this range. And, this might actually turn into something, a little bit more like, I don't want to say draw a line that sharp, but I think we have to realize here is that we now have a high. I mean, these are now, if you look at these are lower highs, lower weekly highs. And it's not to say that energy is just, necessarily outright super bearish, but we now have lower highs and we have a lot of good news priced in here. Good news if you're oil, in terms of unrest. The key point is that this has done its thing. And we had talked about coming off the lows. We talked about several weeks ago, we talked about the geopolitical situation worsening, and it played out kind of as we had indicated it may. But that has happened. And now we're at a spot where the it's making a lower high on the weekly. So I think we got to realize how this might actually enter its own kind of purgatorial phase, like the Russell. Now the XLF, I got to tell you, this is one now that is just like also kind of this weird sector because Berkshire Hathaway, Visa, MasterCard, which have struggled with this whole stablecoin thing. These are in the financials and they're like really weird now. So it's way less cyclical than it used to be. So I think right now this is just very neutral and stuck. I think it may not. So from my view here, it remains stuck in this kind of outside day, this outside week we had back in May. So from my view, this is very range bound. But I think we have to realize is that as time goes on, this is actually getting to a spot when it may actually not perform as it traditionally does, which is being this kind of risk-on financial thing. I did a trading view idea today, or we did a trading view idea on Bank of America. Look at this triangle. It's breaking out of this triangle. You can see the trading view idea. We shared the link. But there's also names like Morgan Stanley, JP Morgan that we've talked about. These names, you might want to look at the level of the individual names here, because some of these other stocks like Berkshire and Visa, these are they have their own issues now. And a lot of them are not going to give you that kind of traditional, risk on market good sort of behavior that you otherwise might expect from the financials. I would say that property and casualty stocks kind of became like value safe havens. And if we get into a tech risk on and falling inflation, it could actually be potentially a problem for some of those names. Remember, property and casualty have been viewed as an inflation hedge because they were able to jack up premiums. And if we start to get into a spot when inflation does moderate, the appeal of those property and casualty names might kind of fade. Now, XLK, technology, biggest sector. And here we had an all-time high last week. Here it is on track, trying to close. And so from my perspective here, we might actually be right now looking at the beginning of a breakout in tech to new all-time highs. So let's see. Last week was an all-time high that did not hold. And I would say that, people might want to look for the potential of us kind of closing. This might actually be, we're on pace for the highest weekly close ever in the XLK. Now it's only Monday, but if we stay here or go higher, that would actually be something that could actually signal longer-term money entering technology. I'll also just very briefly mention, there are some interesting names. I was looking at ServiceNow. I want to just mention that. Had good earnings. It's just kind of pulling back. I don't have it on this chart, but I can show you real quick. The 50-day moving average, I believe, is right there. So there's a company that had good earnings. It's one of those kind of, second-tier names in tech that it performs. It's not as big as some of the others, but I want to just mention that ServiceNow, NOW is the ticker. XLP is just kind of sputtering here. And I will point out, this is kind of like we said, we said if the market was getting bearish, people might actually look for this to break out because that's what the XLP often does. It's kind of languishing here is actually something that also shows risk, potentially bullish risk sentiment overall. This is range bound, and this thing remaining range bound, this could become a lower weekly high here from early May. this actually might be something here where people look for this to kind of bleed lower. And that overall would traditionally be a sign of risk on in the market. I will briefly mention, though, that Walmart, which is in the XLP, is actually potentially, I might do a trading view of this for tomorrow, but it's kind of interesting to see this chart because this is one that, there could be signs here of this having a continuation pattern. It almost looks like a cup and handle, which is a name like Walmart is now basically a tech growth stock because of the way they've been doing the e-commerce stuff. But I want to just kind of point that out, that Walmart here is kind of potentially interesting within the XLP, although the rest of it is kind of dead in the water. Now, real estate investment trusts, we have been noticing for a long time the resistance on the weekly chart, but there could be more bullish things starting to happen now. I mean, this could be starting to form something of a bullish ascending triangle here. And if rates do kind of bleed lower here, this actually could turn into something with some kind of breakout potential. So people might want to look, and I don't have time to get into them, but the wireless tower companies, there's 3 or 4 of them, and they have been just dead in the water for a long time. But people might think that at a certain point in time, things like wireless communication, there could be an AI angle of that, just the tech growing overall. It's an interesting thing to think about. So I want to just kind of mention that as something that I'm starting to kind of look at here. The wireless towers, they are real estate investment trusts. And this is something where if interest rates, if we do get kind of dovish with the Fed, this is a way people might look to play it. So this trend line might be starting to break. You can see it tested it and died. This time it's testing it and staying there, which suggests this trend line could be getting ready to go away. Now, XLU, utilities, these are also, now we talked about how it was stuck under this 83 level, and that has been a relevant point. But now you can see we're building support at 80.18, which is basically a low from that last week of May. So here we're between basically 80 and 83, and the XLU here, this might be something that's also coiling not far below its all-time high. So I think we're going to kind of watch this. There is that whole angle here of AI continuing to kind of be strong for this, domestic manufacturing, whatever it is. But utility, electricity, all that sort of thing kind of is a narrative that's out there. And here it is holding near the high. So, utilities and real estate investment trusts, both of those have not broken down. They've been sitting near that resistance. And that might be something that they don't back down, that people might actually look to push them through to new highs. Now, XLV healthcare remains kind of the weakest sector overall, technically, on the weekly chart here. And from my view, this has a pretty clear kind of range between about 137 down to 129 or 130. And so from my view here, this is something where people might actually see some potential for just range-bound movement in healthcare. There's been a lot of issues with it, and people might actually maybe, project that the sort of political things happening with things like Medicaid cuts and all that stuff, one way or another, regardless of what happens, those sort of issues may have further sort of risk for the sector. There's a lot of public support, in terms of government money going to healthcare, and in a certain way, some of those things, the pendulum could swing the other way, and this sector could be kind of vulnerable to that, potentially for a long period of time, because we could be looking at a long-term secular sort of pattern here. So I think we have to realize here that the healthcare is in a kind of just kind of a doldrums here. And this is something that people might just look at this range to continue. The last one we look at is XLY, consumer discretionary. And this is, I think, actually quite interesting. Tesla starting to do the robo-taxi thing. I was also noticing the pullback in Amazon, which I think is quite interesting here on the daily chart. And, you can kind of just see how that, had a good earnings report, and it's kind of just pushing higher. And here it is kind of trying to hold at a level from back at the beginning of the month. But I think right here, consumer discretionary is in a spot where they're also very tight, and they have not broken down. And people might look for this to kind of accelerate and break out. So I think we have to realize here is that consumer discretionaries could also jump in. Now, the other thing is that they have home builders, and home builders are actually starting to look potentially, they're actually outperforming today. If rates kind of peak, you could actually start to see things like home builders kind of come together. So those are the main things I want to talk about today. Now, we will return let me just look at my calendar really quick. We're going to be returning in July. This week, I'm going to be traveling, so we will not have market trends this Thursday. And then next week is Independence Day. So we're not going to do. I mean, I'm just telling my calendar here. Sorry. So we'll be back. Our next webinar will be Monday, July 7th. We'll do State of the Market again. And then after that, we'll be resuming market trends on Thursday, July 10th. Hope everyone has a great 4th of July. Great, end of June. It's been an interesting first half, a lot of drama. And let's just see what the second half brings. But hope everyone has a great day. And I'll see you next month. Take care.